Good morning, everyone, and welcome. Thank you for joining us today. My name is Doug Dean. I'm the owner and managing partner of Schaefertz and Dean. Our Business Builder Speaker Series was an idea born out of the COVID days in 2020. When we couldn't get together in person, we thought it'd be nice to get together once a month by Zoom and bring on an interesting speaker with a good topic once a month. And we now host these every third Wednesday of the month at 10 a.m. So mark your calendar. Also, we record our Business Builder Speaker Series. We post them on our YouTube channel and we link to them on our website. To find previous editions of our Business Builder Speaker Series, go to our website, schaefertz-dean.com, and under the Resources tab, you'll find all of our Business Builder Speaker Series. And we also encourage you to stay connected with us on all the various socials as they appear on the screen. And in case you missed it, we fill in the chart as we go for the whole year, and all of the prior videos are available in the Resources tab on our website. Go ahead and mark your calendar. The third Wednesday next month is April 16th. Join us Wednesday, April 16th at 10 a.m. for our next Business Builder speaker. Next month, we'll host Bill Borden, broker of High Caliber Realty, on understanding condo and HOA issues. Fine-tune your due diligence skills. So we look forward to having you join us next month as well. Today, we know that you're busy and we appreciate you giving us your time. We encourage you to make the most of our time, encourage you to ask questions and participate with the chat box. And Matthew, I'll monitor the chat box for you and throw questions out as they come through. I'm privileged today to introduce Matthew Johnson, mortgage loan officer with Anchor Home Mortgage, talking about down payments, why sometimes less is more. Maybe you don't need as large a down payment as you might think. I'm going to go ahead and stop sharing my screen and turn it over to Matthew. Go ahead. Thanks, Matthew, for joining us today.
Well, good morning, Doug, and good morning to everyone who's viewing. Super excited and happy to be on this call and share some valuable insight with the team here and hopefully enlighten some folks and create some additional thoughts and questions. I'm going to go ahead and present here. One second. Got a couple screens here, so. Go. All right. That doesn't look right. Hold on. There we go. Okay. I think I figured it out, guys. Nope, it's not working. Hold on. It was just working a second ago.
No worries, Matthew. Take your time and sort it out. For those who have just joined us, I'll introduce Matthew Johnson, mortgage loan officer with Anchor Home Mortgage, and our topic today, down payments, why sometimes less is more. Take it away, Matthew. I saw your screen for a moment, and then it went away.
Yeah, I just want to make sure it's showing the right thing here. Keep showing my wrong screen. All right, so we're not doing slideshow. We're just going to do it the old-fashioned way. All right. Okay, here we go. Oh, a little bit about me. I'm a bilingual mortgage broker. I've been in the industry since 2023. Prior to that, I worked in telecom with a little company called T-Mobile. Some of you guys may have heard of T-Mobile. And I was there for 7 years. I transitioned out of telecom sales to work for a company called Salesforce. If you are in the technology industry, that's a very prominent name. Or if you are in a sales position, you've probably heard the term Salesforce before because it's the #1 CRM in the world. Worked there for 2.5 years and got sick of the corporate world, wanted to work for a smaller company and wanted to get back to helping people. So that's how I landed on mortgage and specialize in condo financing. And that probably it's a kind of a cool headline, but it just means that I am very, very experienced with working on condos. I own my own condo. I'm on my HOA board. And so I have a lot of experience doing condo financing, and a lot of people shy away from it. I actually like to do them. My brokerage is Anchor Home Mortgage. We are based in Alpharetta, Georgia. We're a local company, small organization. We've got about 15 loan officers, about 20 staff total. I currently serve as the sponsorship director for the LGBTQ plus Real Estate Alliance, which is one of the 5 diversity and inclusion groups recognized by the National Association of Real Estate or Realtors. So that's a little bit about me. And I wanted to really kind of jump in what we're going to be talking about today, and which is, there is a common misconception if you're in the industry, especially if you're a real estate agent. You've heard buyers say this before, which is, "Hey, I don't have 20% down. How do I even buy a house?" And sometimes they won't even say it. Sometimes they just have it in their head, and so they never even ask about buying a home. And these are probably the 3 #1 reasons that people choose to put 20% down. Not that they actually put 20% down, the reasons that they choose to. A lot of times, the #1 reason I would say is they want to reduce their monthly payment. That's very common right now because people are so sensitive to the interest rates that they are wanting to reduce their monthly payment. And so they put a large amount down instead of, back in 2020 and 2021, when rates were in the, 3%, sub 3%. A lot of people were doing smaller down payments because they would rather get a mortgage at 3% and save their cash and put their cash into other types of investment. When you're talking about an interest rate that's in the 6s or 7s, that's going to, of course, eat into their capital a little bit. So a lot of people want to reduce that amount that's going towards interest, so they end up applying more to the down payment. They also want, another one is they want to avoid mortgage insurance. This one's like a really big one because people have this in their head that they have to avoid mortgage insurance at all costs. It's like, oh my gosh, if I have to pay mortgage insurance, I'm throwing money down the drain. And while to some extent that can be true, in other extents though, and I'm going to show you guys some actual numbers here and examples of why that's not necessarily the case in actual conversations that I've had with clients about mortgage insurance. But mortgage insurance continues to be a pervasive topic for people where they want to avoid it. Of course, newer home buyers may never have heard of mortgage insurance before, have no idea what it even means. But for maybe someone who's bought a home before, they're very familiar with it, or they have parents who are homeowners. They've probably heard of mortgage insurance, so they've got this idea. And then the third reason is someone told them that they should or that they need to. Someone who maybe did it themselves and doesn't know the actual facts told them, oh, you have to always put 20% down. You definitely should put 20% down. You don't want to pay that mortgage insurance premium. Other people will say, oh, no, you have to put 20% down. You have no other choice. There's no way to buy a home without 20% down. Someone who probably doesn't even own a home told them that. So people listen to all sorts of things to come up with these reasons. Now, these are reasons that people are choosing to put 20% down initially. This is what's going into their minds. But these are conversations that I have with clients all the time, and you can be having with clients as well. So when you're talking to your network or you're talking to a lead and having that conversation around down payments, sometimes that's in their head and you've got to kind of get them to start talking about it. And that's a conversation topic that I have with a buyer. For example, if a buyer comes to me and says they want to put 20% down, I'm not opposed to it, but I always want to understand the logic behind it. So let's walk through some numbers here on what that actually looks like. So this is like a premium client. Hold on, my slides. I don't know why it's switched. Okay, there we go. So this is just a like premium client, meaning 780 credit score. They're going conventional. This is a person who has got money in the bank. Like, okay, cool. I want to put down, 80 grand on my $400,000 home. I want to break down for you the rates for that. So this is rates as of today, 6.75%. Of course, the monthly PMI, which is called private mortgage insurance, that is your, in the case of a conventional loan, that's what you call mortgage insurance on conventional. So, of course, on the 20% down option, you got $0. The principal and interest payment is going to be $20.75. And you can see here how it changes with each 5% increment. When it comes to mortgage insurance and rates, everything is in these 5% increments. So that's why I drew it up that way. So you can see here, even at they can save themselves 5% down and only pay $28.33 per month. Even at the lowest level, at 5% down, of course, we can technically go lower to 3% on a conventional, but for the sake of having more experienced buyers, I want to talk about the 5%. So at 5% down, their mortgage insurance premium on a monthly basis is only $60.17. Now, the logic here is for this type of client, they've got the great credit, and mortgage insurance is basically there's the two main factors that determine mortgage insurance premiums are going to be the FICO. That's the number one thing that they look at when it comes to mortgage insurance, because mortgage insurance is basically saying the likelihood that you're going to foreclose on this property and the risk that the lender's taking is a lot higher at 5% and with a lower credit score. So that's where the two factors come into play. So if you have a lower down payment and you have a lower credit score, your mortgage insurance premium will be higher. But you can see here, even at 5% down, that's 15% more cash in their pocket. They're only paying $60 a month on a, what is that, a $380,000 loan. So a pretty minimal amount of money. You can see the difference in the payment doesn't go up significantly. So the logic for a person like this, if they came to me, I would say, look, if your reasoning is just to avoid mortgage insurance premiums completely, let's talk about what that costs on a monthly basis so you fully understand exactly how much it costs for you to go less down. And the other question I have for a client like this would be, if payment isn't necessarily a major factor, is there anything else that you could put your money into? For somebody who's got some of this cash, they may want to keep that money. Like they could be pulling money out of an investment account to buy this home. They could be pulling money out of a brokerage account. They could be pulling money out of a retirement account in order to purchase this home because, again, they have in their head that they need 20% down. Well, when I walk them through this and I show them, hey, look, you can keep those funds inside of your brokerage account or your retirement account and only pay $60 a month extra as a premium, so to speak, to keep that money outside of the mortgage. So keep that cash kind of working for you in the stock market or wherever market it needs to go, and avoid paying that premium. That's a conversation I would have with a client like this. Now, I did want to show you how it compares. So if we drop it down to a 720 score, which for a lot of people, 720 is like a great credit score. So 720 for people means a lot. However, 720 is really good credit. It's not great credit or excellent credit. It's good credit. Difference here, you can see the rate went up. So of course, on the people always understand the rate goes up with a higher credit, lower credit score, but they don't understand how that impacts the mortgage insurance premium. So you can see here the PMI at each level there. So it is significantly higher. I mean, almost double at the 5% down range. Not only is the rate higher, but the mortgage insurance premium is almost double. It was what, $60? Yeah, $60 at a 780 or higher, and 114 at a 720. So now we're talking about maybe it does make sense to go with a little bit higher down payment. So again, I'm going to have this conversation to look at the monthly cost of having less down in that scenario. They're going to just be paying more money in that case. So it might make sense for us to do that. But again, I'm looking at it like, hey, for this type of client, I'm going to look at their whole credit report. I'm going to look at what other debts they might have. And I'm going to say, look, if you can go, what if instead of doing 20% down, you did 10% down, you pay the $75 a month for a while, but maybe you apply the extra 10% that you would have applied towards your home. Maybe you apply it over here to this credit card debt that you have and pay that credit card debt off so that you're saving money on that end. Is $75 less than what you're paying in interest over here on this debt? And I'm going to have that conversation with them because many people will hold on to some bad debt over here and think that they need to apply their liquid funds to their mortgage. But in reality, again, for $75 a month, they can keep that extra 10% and they can invest that into paying off other debts or other types of things. So again, a conversation piece I'm going to have with the client and kind of help them understand the math behind this. And just for kicks and giggles, I want to show you guys this. So technically, you can get a conventional loan with a 620 FICO score. It's not common, and this is exactly why. So if you look at this graphic here, of course, same thing at 20% down, you're not paying any mortgage insurance. So if someone has 20% down, it's not a bad idea to go conventional depending on the reasoning behind it. Maybe they're buying a home that needs conventional. Well, we could do a conventional loan here. But look how high the mortgage insurance premium jumps up at each increment. At 15% down, it goes up to nearly $100 a month. At 10% down, it is 243, and then jumps way up to $370. And trust me when I say you don't even want to see the 3% down. It's like $500 a month or something like that. So it is really, really high. I would never recommend somebody at a 620 score get a conventional loan unless they're able to put 20% down, because that mortgage insurance premium is abusive. The other piece I think that buyers forget about is that the home typically appreciates, right? If you're in the industry, you understand that real estate typically over the long term will appreciate. Obviously, you have this sort of up and down market, but over the long term, the home is going to appreciate. And they're going to also be, of course, making principal payments, so reducing that loan balance. And what happens is naturally when the home appreciates to a point where they have a 20% equity stake in the home, they can actually ask the lender, their servicer, to do an appraisal on the property and remove mortgage insurance premium. So somebody doesn't have to keep mortgage insurance for 10 years like they think they do. They may only have to keep it for a couple of years if their home appreciates enough. I mean, that happened in my case. I bought a condo in the end of 2021. And I was a year later, because of the appreciation in the condo market at that time, I was lucky. I certainly wasn't planning for this, but the condo market had gone up so much, and I had invested money into my property to renovate it. And I was able to just drop mortgage insurance premium after 1 year because the value of my property had gone up so much. So that's an option too for people who are thinking in their head, oh, I need to avoid mortgage insurance. Well, yes, you do. And you may want to, but understand that mortgage insurance isn't forever. It is a period of time on the loan, and it's not going to be there forever. So there are multiple reasons why they may not want to do that. Now, that's conventional. And I think it's important to understand how mortgage insurance operates on the conventional side. But let's flip over to FHA and talk about how FHA really changes the conversation around mortgage insurance premiums. So on FHA, I put it on here, but it's actually not called PMI. It's actually called MIP, which is mortgage insurance premium. I need to switch that. But either way, it's mortgage insurance, right? The big difference with FHA is that the mortgage insurance is not based on credit score. It's not based on down payment. The mortgage insurance premium is a flat rate based on pretty much 100% based on the loan amount. So in this case, you can see the mortgage insurance premium going up, but it's only going up because the loan amount's going up. So at 20% down, that's a $320,000 loan. At 15% down, 340, 360, 380. That's where the loan balances are, and that's why you're seeing the increase in the mortgage insurance premium. So somebody with a 720, I may suggest to them that they get an FHA loan, and I want to compare that with you guys. So this is what it would look like at 720 if we did FHA. Notice that even at 20% down, they still have to pay a mortgage insurance premium. That's important to understand because FHA, there is no option to waive mortgage insurance. Even you could put 50% down. You still have to pay mortgage insurance premium. So somebody with a 20% down payment, I'm going to push them towards conventional, regardless of what their score is, unless they literally can't qualify for conventional, because I know that they can avoid mortgage insurance premium by being in a conventional loan. If they are not putting 20% down and they're in this sort of credit score range, I'm likely going to tell them to go to an FHA loan versus a conventional. Now, look at the comparison here. At 5% down, it's $114 a month. On FHA, it's $175, right? The rate's lower though. So if we look at payment wise, the payment on a conventional loan, it's at this range. If you look at the interest rate plus mortgage insurance premium, the P&I payment is $2639.60 on the bottom right hand corner there. So $2639.60 is your mortgage payment if you did the same person did 5% down and did on conventional, or versus doing 3.5% down, which is the minimum on FHA. They can save themselves $100 a month, $110 a month by just going FHA. Even though the mortgage insurance premium is technically higher, because of the reduced rates in FHA, it makes more sense for them to go to FHA. So these are, again, conversations that I'm going to have with the client to fit them to the right loan. And for those of you who have done listings and think in your head that FHA is somehow a weaker loan or a weaker buyer. That's not necessarily the case. This is potentially a very strong buyer that just doesn't have the amazing credit, but has good credit, has money. Maybe they have enough money to put 20% down, but we're putting them in an FHA loan in order to reduce their payment as much as possible and really save them as much money as possible. That's ultimately the reason. So if you see FHA, it does not mean broke. It does not mean don't have money. It doesn't mean even bad credit. It just means that was the right loan program for that specific buyer to go into. Flip this over to a 620 score. So this is where FHA really becomes advantageous for a buyer. You'll notice that the mortgage insurance premium is almost the same across the board. And again, it's really because it's only based on the loan amount. So the loan amount is going to be the same. What's changing though is the interest rate changes. So the numbers change a little bit, but you can see here, even going from a 720 plus down to a 620 plus, we're barely increasing the rate. So again, a client like this, they're definitely going to want to look at ways to reduce their down payment. And the reason is somebody at a 620 is typically going to be sitting on higher interest debt. If they have a 620 credit score, they're probably going to have a higher interest car loan. They're probably going to have credit card debt, things like that. So this type of client, even if they have 20% down, unless we really need to reduce that payment down to a certain level for maybe debt to income requirements or just to get them more comfortable with the payment, I'm going to suggest to them that they do less down. On FHA, I typically tell people to go with less down unless they really need to reduce that payment down. But the vast majority, I would say 90+% of FHA buyers are going to be in that 3.5% down payment range. So again, having that conversation with the client, that's really how I structure my conversations around down payments. If someone says, hey, how much down do I need? I don't just answer the question. I always ask them, well, what's your credit score? Because that's going to help me determine what loan program we're going to be doing. And then I can help kind of formulate the whole plan. But as you can see through these illustrations, it's more complex than just, oh, I want to put 20% down and that way I can save the money. There are multiple reasons why somebody would put less down. And these are just a few of them. So that's really like the presentation side of it. Now, there's a whole nother side of down payment, which is the down payment assistance piece, right? Which is somebody literally doesn't have the down payment. That's a whole nother conversation, but this is for specifically clients who have at least the minimum down of 3% or 3.5% in the case of FHA. If they have that, then great, we're going to talk through this. But again, there's a lot of people coming to the table who have higher down payment amounts, and I'm having that conversation with them. Now, how do you guys use this information? The way you can use this is in your conversations with your network, with your people that you know in your life who, again, may have this idea in their head that they need to put more down, or they can't possibly buy a home because they don't have 20% down. So how could they possibly do it? Well, hey, look, there are options for lower down payment. It's just not as costly as you think it is. What's your credit score? That can make a difference. And having that conversation with them. But the biggest suggestion I can give you there is get them in contact with whoever your preferred lender is. Whether it be myself or another lending partner, make sure you get them in contact with them to have that conversation, because a lender can have a very good conversation and an educational conversation and really help analyze and help break down some of those barriers that they may have around down payments. So that's all I have from a presentation standpoint. I don't have a whole lot of other things to share from that perspective. Doug, I'll throw it back to you in case you had some specific questions, or maybe you wanted to open it up for questions from the group.
Matthew, thank you for your presentation. It's really interesting to see the holistic view, even comparing FHA to conventional, and how there can be a difference in rate, which can offset some of the other considerations and so forth. So it's really fascinating to see how each of the loans stack up with the different criteria. I'll go ahead and throw it open to the floor. Does anyone have any questions about the material that we've covered, about how down payment plays into the monthly payment and the mortgage insurance?
Doug, Matt, this is Mike Malone.
Yes,
Matt,
Mike.
thank you so much for the information. I do have a question. I was very clear on you saying On a conventional loan, eventually, as values increase, the PMI can fall off, or can or will fall off. Does it do the same with the FHA loan?
Great question. It does not. And this is another reason why it may, unless they put 10% down. If they put 10% down on FHA, yes, it does come off. I believe, don't quote me on this, but I believe it's 10 years. The mortgage insurance will fall off. That they have to put 10% down and then they have to keep stay in that loan. As far as generally, though, if it's less than 10% down, no, FHA, the mortgage insurance stays on there the entire life of the loan, unless they,
So
of course,
you,
refinance it.
so it has to be 10% above in down payment.
Yep. Now,
Another question.
the conversations I'm having with clients right now is there's almost no thought that they're going to keep the loan that long because of where rates are at. We fully expect everyone to refinance at some point in the
Yes.
future. So that's typically the conversation I'm having with them.
Okay. Another question for you. I heard you say you kind of specialize in condominiums,
Mm-hmm.
and that's kind of music to my ear because somehow I fall into condominiums often. And what are the challenges with financing condominiums? So often, some of them qualify to be FHA or not qualify to be FHA. What are the challenges there?
Yeah. So number one, really great question. I think this is probably a question more people need to ask. And from my experience, the factor that makes condos more challenging to finance is on a typical transaction where you're financing, a standard single family home. All the underwriters really looking at are two things. They're looking at the borrower's ability to repay, and they have guidelines associated with that. And over here, they're looking at the property's ability to basically collateralize the loan. So is the collateral sufficient to support the loan that's going on it? And if something were to happen, that the buyer were to foreclose, could the lender recoup some of their money? Those are the two things they're looking at. When it comes to condos, though, there's a third layer, which is the condo association. Because in condos, as you know, Michael, is it Mike or Michael?
I answer to a lot worse, so either one is great.
All right. So, Mike, they have to look at the condo association because, as you know, when you own a condo, you only own the interior. So it's a walls in type ownership. So you just own the interior. Now you're a member of the HOA community. You're one of the quote unquote shareholders of the community, but the community is ultimately owned. The outside the buildings and everything related to it, the entire property is owned by the HOA. And that's a whole separate underwriting piece. That's a third layer that has to be underwritten, meaning that an underwriter has to look at what's the strength of this HOA? Do they have the proper amount of reserves? Are they financially strong? Do they have a lot of members that are delinquent on their dues? Because if dues aren't coming in and the HOA doesn't have money to pay the expenses associated with managing the property, well, that's a problem. That HOA could become solvent and ultimately fall completely apart. And that drastically devalues the condos within the community. So they have to make sure that all that's in place. That some of the bigger items right now that are coming across are, of course, reserve requirements have grown because of what happened in Florida. And then also insurance requirements. Insurance continues to skyrocket for condo associations, especially as condos are getting older. So that's a whole nother side of it. In fact, condo financing is so complex that lenders have a specialized team just to underwrite condos. They literally have a team that all they do is double check condo documents. And many lenders right now are outsourcing it to companies who just do that 100% of the time because they don't want the risk associated with underwriting a condo and then the condo loan gets rejected by the investor buying the loan. They don't want to take on that risk. So they're bringing in third parties to do that process. So that's a big reason that that condos are more difficult to finance. I feel like you had another question in there.
Well, I mean, everything you're telling me, I understand. I don't like it, but I understand it. But they are challenging. The older they get, the more complicated getting a loan approved for one becomes. And I'm looking at it not just from the buyer perspective, but the seller perspective of somebody who's bought one and okay, I've outgrown this thing and I'm ready to get out, but can I get out? And
Yeah, and I think
that can be a problem.
it can, and I do think that this is where, as listing agents, this is where you can provide a ton of value. Is having the conversation. For example, being on the board of my own HOA, I've had to bail out a seller before and help him because we were having issues with financing on the condos in my own community. So I had to make some changes. So having a board, at least one board member who is sympathetic to the situation and actually cares, as many HOA members just do not care because they're not the ones selling. They're the ones staying and they don't really care. They don't understand why not being able to sell a condo is a major problem for everybody. And so helping conceptualize that. So I've had many conversations with boards, and this is where having an experienced loan officer who understands condos is incredibly valuable because I can get on the phone with the property manager or I can get on a phone with an HOA member and I can have a conversation with them and tell them exactly what we need to do in order to make the loan qualify and what changes need to be made. And most loan officers don't know how to do that because they have no experience on condos. They run away from condos. I have a very in-depth understanding of them. And so I've had to do that multiple times, jump on the phone with the president of the board and say, hey, you need to make this change. You need to make this change in order for us to make these condos warrantable and for your owners to be able to sell them. And I also express to them why it's so important for them to have that ability and because how it impacts them and the values of their property and the potential legal side. I mean, if several owners are unable to sell their units and it's directly because the board made a decision related to that, let's say that they chose not to put enough money in their reserves or they chose to choose an insurance policy that doesn't have the right coverages, now you open yourselves up to a lawsuit potentially from those sellers. And that's a risk. As soon as you say that, all of a sudden HOA board members go, oh, okay, we should probably listen to this. So having those types of conversations with them. So I would say number one thing, because I think this is what you asked about, was how to properly prepare as an agent, whether you're on the listing side or the buy side of a condo, is if you're on the buy side, working with a lender, not only the loan officer, but this is where I believe brokers really can be more valuable because brokers have access to multiple lenders. And when you're doing condo financing, you have to have multiple options available for condo financing because one lender might have an overlay that says, yeah, we won't do this condo because of this reason. And then so I got to take the loan over to another lender and have them instead underwrite it because they're willing to take the risk on it. And that's where brokers can really win on a condo side versus if you go to a direct lender. I'm not going to name any names here, but some a bank or a direct lender, they've got their guidelines and they can't switch. They can't switch it over to a different lending partner to do that loan. So it restricts their ability and what type of condos they can do. On the flip side of the listing side, you as a listing agent can really bring a ton of value by really getting your seller to pay for the condo docs ahead of time. Condo docs typically cost a few $100s. Have them order the condo docs. If their property management company will provide them for free, great. Get those condo docs, get a preferred lender. I'd like to put myself in the ring for that. And allow me to review the documents because I can look at a questionnaire and I can look at the reserves and the budget and the insurance policy and I can tell you this is not going to qualify. These changes need to be made. And the reason you want to do that is because now when you're listing it, you know our condos are good to go. We can sell to Fannie, we can sell to Freddie. We don't have to worry about non-QM loans. The other cool thing is I do FHA single unit approvals. So even if a community is not FHA approved, I can do an FHA loan on a single unit. Again, that requires that we order specific condo documents from the community. There's a specific questionnaire they have to complete, and there are different requirements. There are many condos that can't go conventional because conventional, Fannie and Freddie, have specific requirements for those condos, but they can go FHA because FHA doesn't have that same requirement. It had to happen with several condos where we could not go conventional because of the insurance policy that they had, but FHA did not care about that specific insurance policy. So we did a one-time single unit approval on FHA and ultimately got FHA approved. And to me, that's a huge value add for a listing. If you can say, yes, we can do FHA on this condo, that will bring in a ton more buyers and will provide a lot more options for the seller.
You're giving me some options. I'm going to see about, I have one listed right now that I don't know for a fact, but I believe it's questionable. But I'm going to see about getting those condo docs ordered. And what am I asking the association for specifically?
I'm sorry, can you repeat the question?
I'm going to see about ordering the condo docs for a listing that I have right now. So specifically, what am I going to ask the association for?
They're used to this, and it's not necessarily the board. Most communities are managed by a property management company. There's a ton of big ones in the Atlanta market. And so normally there's a property manager that you'll deal with. It would be in your community association disclosure, the CAD. It would list who the property management company is, who the contact person is. There's usually one person, and they can tell you how to order condo docs. Sometimes the condo docs are free. You just have the property manager prepares them for you. Other places will use a website where you go and pay $300 or $400 to get those condo docs prepared. So that's who I'd go to first is the property manager and ask them.
Okay. I mean, it's access management. They've been in the game a long time, so
Yep.
they
Yeah,
should
I
be.
think they definitely have a website where you go to order the condo docs. It's usually like $300 or $400 for all the documents.
Okay.
And I can, if you call me, I can tell you specifically what needs to be ordered by your seller. And again, it's a small investment for the seller, but can for a lot of sellers, they can't even sell a condo. It's not even about selling it quickly. It's about they can't even sell it at all. So
Yeah. Yeah. Okay. Well, I appreciate that, Matt.
yeah, hopefully that helps. Thanks for
Matthew,
the kind words, Warren.
One of the questions thrown out was about how the MI will drop off at some point on a conventional, but not on an FHA unless you have at least 10% down. But the mortgage insurance on a conventional is fixed for a duration. Correct me if I'm wrong, but FHA mortgage insurance will decrease slightly every year for the life of the loan. So it does change and go down, generally speaking, year
It
over
does.
year.
It's based on the amount of the loan, correct. And you do the other thing about FHA, by the way, is that you do pay an upfront mortgage insurance premium as well, which is a 1.75%. If you've ever done an FHA exhibit on a contract, you would have seen that. It's 1.75% of the loan. And there's a little checkbox. One is added to the balance of the loan or paid for at closing. And 99.999% of people just add it to the balance of their loan. It's a few $1,000s and barely impacts the payment, and they'd say that on the front end. So that's another piece you don't have with conventional. You don't pay an upfront mortgage insurance premium. You just pay the monthly premium.
A lot of great information. What other questions do you have specifically regard to down payment or selection of loan? And I know that we've mentioned specifically comparing conventional and FHA. I'm assuming that the analysis for FHA is roughly comparable for maybe, I know that VA, you just pay a funding fee and don't have mortgage insurance. Is that correct?
Yeah, so VA doesn't have any monthly premiums. You just pay the funding fee if you're not disabled, which is most veterans getting a loan are, I would say the majority do not have a service related disability, so they end up paying the funding fee, which again can be added to the loan or paid at closing, whatever they choose to do. But no, there is no monthly premium for VA. There is a monthly premium for USDA loans for those who are in more rural areas. USDA loans do have a small premium. It's minimal compared to like a conventional or an FHA, but there is a premium associated with USDA loans as well.
One interesting thing about USDA, and I'm not sure how often the maps are updated, but areas that we might previously have thought of as rural have become more developed. And, there's golf course communities now in what was previously considered a rural area. So if you're working with a buyer, it's always worth checking and seeing if it qualifies for USDA.
Definitely. And you can always
ask. An option.
Yeah, and you can always ask me, like it's really easy for me to look it up. If you've never looked it up before, I can easily look it up and tell you if the area qualifies. So
really just incredible information, Matthew. You're really great at breaking everything down and making things super simple. So I'm very excited to get this video to send out. I think it was very informative and should help a lot of people.
Fantastic. Once we conclude our speaker series today, we take the video, we clean it up, add a little credits and theme music at the beginning and the end, make it look professional. And it'll take generally about a week. It'll get posted within about a week. Typically can be less, but give us up to a week to have it posted, and we do send out a link and let you know when it's available. And the great thing about that is if you have questions about the material later, you can always go back and re-review our presentation from today. And like Melissa said, share it with others who will find value in our conversation today. Just
I appreciate it, Melissa.
Thanks.
Just to expand on some of Matthew's comments, we are hosting our next month's speaker. This is a great lead-in because a big part of the loan approval on the FHA dealt with condo issues. And our speaker next month will be speaking specifically to HOA and condo agent issues and helping agents sharpen their due diligence skills. A lot of the things we've touched on will go into a little more detail about what to know, what to ask for, what are limiting factors that affect your ability to obtain certain types of financing in certain communities. I wish I could take credit that the two lead together so well, but it's fortuitous as much as planning.
Well, I'm for sure going to be on that call because I want to hear the take on that.
Yeah, same. I look forward to it. I'll see you guys. I'm going to hop off for 11.
All right. Thank you, Melissa. Before we go ahead and break for our session today, does anyone have any additional questions about selection of loan type in relation to down payment? If not, I'm going to share my screen and just conclude. We just want to say thank you, a special thank you to Matthew Johnson, Anchor Home Loans, for being our guest speaker today. And I'd like to thank each of you for joining our presentation today. One of my favorite quotes is from the Kenny Rogers song, The Gambler. At the end, he said, "I hope you found an ace that you can keep." So we appreciate your participation today and hope you walked away with some more skills and knowledge, and wish you all the best and success in your real estate business. And on behalf of Anchor Home Mortgage, Shay Fritz and Dean, thank you for joining us today, and we look forward to the opportunity to serve you in the future. Thanks, everybody. Have a great day, and let us know how we can help you.